Hi, my name is Stuart. Welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. Okay, let's get into today's Q&A episode. First question is from Kyle. Kyle writes, thanks for the podcast. Appreciate the consistent quality content each week. My questions are about the process of selecting stocks to invest in. Firstly, what are the main resources, websites or apps you use to research stocks, both relatively known stocks and unknown stocks? Secondly, what key metrics, data or features are you looking for to determine whether a stock or share is worth investing in? Please clarify different metrics depending on which type of stock you're looking at to invest in, that is defensive, high income, growth, and so on. Okay, that's a pretty broad question. Firstly, I'm going to kind of reframe it. When you talk about stocks, I don't invest in direct shares, as in buy CSL, BHP, CBA, Nvidia, and these sorts of names. The evidence shows that picking stocks is, to borrow Burton Melke's phrase, who was one of the founders of Vanguard, picking stocks is like picking a needle in a haystack. Just invest in the haystack, which is the index. And in developed markets, it's what you don't invest in that will hurt you, not what you do. So, what you're missing out on by not holding the broad index is what's going to hurt you. In emerging markets, it's a bit different. It's what you don't invest in that's actually probably going to drive most of your returns. That's just because performance and the type of market we're dealing with, in terms of there's less transparency, oversight in emerging markets. Typically in many emerging markets we have a lot of government owned or co-owned entities which bring their own kind of uniqueness, if you like. You're not really investing in a pure commercial enterprise in those situations. Anyway, so that's the answer to, invest in ETFs. But to answer Kyle's question, how do I pick the ETFs to invest in and which metrics do I use? Well, perfect timing. On the 22nd of April this month, in a few weeks, in fact, I've got an episode that takes you through how we go about constructing an ETF portfolio. So I reckon that episode will answer Kyle's question. The one observation I have, though, I just answered a question this morning on our website. It was a question attached to one of my past blogs. And someone was investing in DAVA, which is Dimensional Value Australia. Dimensional is how do you describe them? They're an evidence-based, rules-based approach that is rooted in a lot of academic research around what drives share market returns. A really interesting beast. Maybe I should do a full episode on Dimensional. But they've been around a long time, since the 90s in Australia, and they were started in the 80s in the US. Got a long track record. And, if you go to university and study economics or finance, many of the textbooks, I don't know about today, but certainly when I was studying, and they're, kind of evergreen textbooks, but many of the textbooks you'll use written by some of the people that have been on the board of Dimensional, so very academic. And anyway, they were using, as I said, this person was asking about DAVA, that person was investing in that. And I said, no, you should invest in DACE, which is Dimensional Australia Core. The key observation here is you've got to understand what you're investing in. Like, you can get a little bit, it's not terrible. The dimensional value is not terrible. The difference between value and core, the core has 3-factor tilts that are rooted in economic research. So value, and dimensional use price to book as a measure of value. They also tilt towards profitability. So sector profitability are those in a particular sector that have higher profitability than their peers, and size. So tilt more towards small away from large. There's an observed premium that small cap companies deliver over a long period of time. Not always, but over a long period of time. So it's a better strategy because you've got those 3-factor tilts that are all working in the one portfolio as opposed to 1-factor tilt. But I guess the thing here is, and even with respect to the episode on the 22nd, is that, there's no shortcuts here, I don't think. I mean, you ask about how we pick ETFs. The answer is that we're across all ETFs pretty much in Australia, and certainly across the main providers of those ETFs, and there's probably only about 5. and we meet with them regularly. So we meet with those businesses regularly and we interrogate them in terms of, their methodologies, what's working, why is performance a little bit different to what we might expect in some situations, why are certain managed funds or ETFs distributing too much income? I mean, that's happened before. We had a conversation with Vanguard last year about that. So, we're bringing a lot more, I guess, research to it than just, let's pick a few names that, has value in the name or something. So that's good. You've got to really look under the hood and understand it. Anyway, I'm going to take you through sort of the approach that I take, but we take on the 22nd, as I said. But the approach is a methodology. The implementation of that methodology is really a lot of research and understanding and reading and really looking very closely at the portfolio attributes, which I'm going to talk about on the 22nd a little bit. But, I'm not saying you can't do it as novices or, as people that aren't doing this every day of the week. What I'm saying is that we're talking about this sort of stuff on a daily basis and we spend a lot of time getting deep in it. So, there's that distinction, as you should expect, right? As should be the case really in any professional situation. I might be able to research the law, but if it's property law, for example, but if I go to a property lawyer, I'm sure they're going to be a million times better than I am at it. Anyway, Kyle, thanks for your question, and I look forward to sharing that episode in a couple of weeks' time. Okay, let's get into the next question that's recorded from Jack. So, Jack, over to you.
Hi, Stuart. Love the podcast. Insights are invaluable. I'm fortunate enough to be able to 360,000 into my self-managed super fund, non-concessional contributions. I've got 18 shares and ETFs in my portfolio at the moment, accumulated over the years. I'm thinking of changing it down to a more manageable few ETFs, things like VHY, VGS, hybrid, and either DHHF or GHHF, and then reinvesting the dividends with that 360,000. And then once I was retired, I'd then sell the 18 individual shares and contribute to the 5 ETFs left. And then once I get to the point where I retire, I'd then also convert from reinvesting the dividends into income. Would love to know your thoughts on that as an idea, or would it be better just to split my 360 across the 18 shares and ETFs I currently have?
Okay, so let's have a go at answering Jack's question. So thanks for recording it, Jack. Hopefully it breaks up, as I said last week, breaks up, my monotonous voice. And isn't it ironic that I write, I only just finished it yesterday, writing the blog about, how to construct an ETF portfolio. Isn't it funny that then the two questions that I subsequently answer are directly related to that? I mean, it's nice. So just to summarize, Jack's got a bunch of different ETFs and direct holdings. He's got NDQ, which is NASDAQ. He's got AMP, which is just AMP. ACDC, which is minerals, I think. I can't remember they've got robots, which is robotics. STW, which is the Aussie market. TLS, which is Telstra. Westpac, he's got Westpac. VAE. So it's kind of a mismatch of a lot of different ETFs. So firstly, to answer the question, Jack's question, should I do what he said, which is VGS, hybrid, DHHF, and so forth, or spread it across the existing holdings? Well, I wouldn't spread it across the existing holdings because some of them I wouldn't buy today. NDQ I wouldn't buy. I think it's overcooked. Telstra is it's rare that it's trading above $4 and it's been doing that for a while. I'd be selling that. I mean, it tends to trade between $3 and $4.50 and it's done that for almost 20 years. I think it's a growth stock. I don't think it's worth investing in. Westpac, Westpac's had a really good run. I think I'd be taking my money and moving on. So some of these holdings aren't attractive. And this is what I'm going to talk about on the 22nd in the episode that I just mentioned to the previous listener, is that I'm going to talk about a value-aware asset allocation. So we want to be conscious of that. So let's look at then Jack's alternates. So VHY is a high yield, Aussie high yield. VGS is Vanguard Global. HBRD is okay. We used to use HBRD, but very long sort of explanation. But essentially, ASIC's really sort of winding the hybrid market down because banks can't sell hybrid investments to retail investors. investors anymore. So I just don't think they're going to be used anymore. And I think that there's only like 20 holdings, 20 hybrids left. So HBRD, which is BetaShares hybrid fund, isn't actually a hybrid fund anymore. It mostly invests in subordinated debt. So you're paying sort of double the fees. I mean, it was worthwhile paying the fee for an actively managed hybrid fund because what they were doing is really valuing those hybrids and then only investing in hybrids that, were priced as a bond rather than as an equity. The potential conversion to equity was very low. The probability was very low. That was worthwhile because it goes to the underlying portfolio's risk. Whereas they're not doing that anymore. The manager, Coolabah Capital, of that ETF has decided the hybrid market's too small now. It's certainly too small for the amount of money in the fund. So they then have to find other assets to invest in. I know Chris Joy, who runs Coolabah Capital, prefers subordinated debt. And so that's what he's done. So now the fund, and these are the things, right? It's not set and forget either sometimes with these ETFs. You need to really understand what's going on. So I wouldn't use hybrid anymore. We use VanEck Subordinated Debt Fund, SUBED, sub D is the ticker code. It's about half the cost of HBRD and it doesn't have any interest rate risk. So zero duration, which is good, particularly, this year, interest rate expectations have changed a lot. So it's really capital stable and you're going to get 5.5% linked to the RBA paid each month. So it's a good level of income. So no HBRD. If you want a defensive, I'd probably go sub D. I don't think VHY, Campbell did the episode a few weeks ago around, the Aussie market. And, the dividends off the Aussie market, they've declined partly because of two things. The market has appreciated, still not as much as, other developed markets. So it's still underperformed, but it has appreciated. But Australian earnings haven't really changed that much or hasn't changed in line with the appreciation. So now the dividend yield of the market, something like 3.5% or circa that. It's not that attractive anymore. Now VHY is a good fund for high yield. But I'm just concerned about what we're investing in to get that high yield. So banks are already quite high. The miners are going to have some challenges. The market's really dominated by materials, the miners, and financials, the banks. So I'm not attracted to that. DHHF, I like. You've only got 10% in that, but I'd put a reasonable proportion in that. And the other diversified fund you might want to throw in there is VDAL, which is Vanguard's All Growth Fund. So, look, I think I would probably split it. This is not advice, observation only. But I think, Jack, what I would do is spread that 360 across DHHF, Vanguard's All Growth, so VDAL, and maybe the 20% in sub D. So you might go 40-40-20. For instance, which means you're going 80% all growth and 20% defensive. Subject to maybe listening to the episode on the 22nd. So that's how I'd structure a sort of diversified fund using diversified ETF. But the other option is to structure the portfolio yourself. But thanks for submitting your question, and hopefully you look out for the episode on the 22nd, which will probably complement my answer. Okay, next question is from Dave. Actually received this, when did I receive it? On the 2nd of January. So I've started this year's questions. We didn't get that many in February, so I should, hopefully Campbell and I catch up. Maybe I'll force Campbell to do some more episodes. Okay, so Dave's sent me an email and a spreadsheet, and he's done a comparison between, it's a really interesting one, actually. Interesting question, interesting observation. He's done a comparison between debt recycling into shares, so that is using borrowing against the equity in the home to invest in the share market, 250 grand, or going and buying an investment property for $800,000. And so he's spreadsheeted it. And he's a little bit surprised that the investment property isn't a lot better. It is better in terms of it does produce more wealth, about $500,000 more wealth, but it puts him in an inferior situation in terms of, because the holding costs of the investment property, it retards his ability to reduce his home loan, repay his home loan. So he ends up still with a little bit of a home loan, but $800,000 more wealth in investment assets. So the net difference, 300 minus 800, is about $500,000. And so he's asked a few questions and asked about sort of assumptions and so forth. And I think probably this scenario, it shows that we need to, the default is go and buy an investment property. And I speak about a lot in the podcast. The default by buying investment property be often the best results long term, but short to medium term, maybe not so much. And gearing to a lower level, because obviously we're comparing $250,000 of gearing versus 800. You would expect mathematically that the 800 is going to win. And if you look at the asset values alone, so the investment asset values alone, it does win. It's about $800,000 better off after 20 years, according to Dave's assumptions and model. And I've looked at it broadly. I haven't audited the spreadsheet, but it looks broadly correct. So it is better. But that's better in isolation because there's an opportunity cost. The opportunity cost is it's costing me more cash flow along the way over that 20 years. And that means then I can't repay my home loan faster. So it's an interesting exercise and a great question from Dave because it does highlight that we can't look at things in isolation. We need to apply the right approach to the strategy. And so sometimes borrowing to invest in the share market is a better strategy than property. And, if they're going to change the tax rules, there might be some other advantages as well in terms of CGT tax rules. So that's an interesting observation. The other observation too is to understand financial modeling. And of course, I did an episode a few weeks ago about, garbage in, garbage out. So if the assumptions aren't correct, or you can manipulate the assumptions to get any results. So you want to make sure the assumptions are correct and conservative. And by the way, I think Dave's not exactly what we would use, but very close. And, I think they're reasonable and defensible assumptions. So whatever Dave's used has been good. So that's just for Dave's benefit, that comment. But also understanding how different assets will perform at different periods of time. So Dave did a 20-year forecast here. And yeah, investment property is good, but there's an opportunity cost because we still have a home loan. Not that big a deal. You could go and sell because he did do the numbers net of CGT. So he still could go sell the property and still be better off by about $500,000, right? And get rid of the home loan, sell the investment property, get rid of the home loan. So it isn't a superior strategy. But if he forecast out to 30 years, so add another decade, property would really start to win, which I'm not saying that would be the basis for investing in property. What you need to do, as I said, you need to pick a strategy that aligns to your goals, that's going to get you where you need to be and without necessarily producing excessive wealth. So what's the point of generating more wealth than you're actually ever going to need? What you want to do is choose the path that balances everything out. Your ability to enjoy life today and over the next 20 years, your ability to make you feel financially safe and secure, like repaying your home loan, while still making sure you've got enough money to enjoy a very comfortable retirement. You want to tick all those three boxes. It's not just about a race to accumulating as much wealth as possible. If it is, then in Dave's situation, it's probably buying investment property because in the long run, given compounding capital growth, that's and higher level of gearing, it's mathematically going to be a superior option. And last week I spoke about lump sum share investing, so it's a practical option from that perspective as well. Okay, so Dave's got a couple of questions, more practical setup questions really. Okay, so the question is, can I split my home loan into two components, so the home loan and the shares component? And do I need to tell the bank that I'm doing this for investment purposes? So you can go and split your loan, or in fact, just establish a completely separate new loan. So that's fine, and many lenders do that. And some lenders will let you split loans accounts out just online through internet banking. So it's pretty simple and easy. The question: do I need to tell the bank I'm doing it for investment purposes? They're going to want, credit is going to want to know not always, but often want to know what you're doing with the money. So if you don't say it's for investment purposes, then you've got to say that it's for non-investment purposes. And they might then start thinking, well, what are you doing? Are you making alterations to the house, right? Renovating or something like that. Do you have a gambling problem? And, we're giving you $250,000 and you're going to just go and gamble? Or, you're going on a holiday, what are you doing with the money? They've got a legal obligation to ask questions, to verify purpose, to protect people from exactly those sorts. If someone's got an addiction like gambling, the bank wouldn't be doing the right thing by giving that person the money to go and gamble and waste away. So practically, you're going to have to come up with an answer to what are you going to do with the money, and so I think you're going to have to disclose that it's for investment purposes. I mean, you've got to be honest with these things. That means that you're going to pay a slightly higher interest rate, which links into these other questions about repayment structure. But it is what it is. And what you want to do is demonstrate, that you want to have a clear purpose here. I've disclosed to the bank, this is what I'm using the funds for. I'm going to invest it in the share market. And it just builds more and more evidence to demonstrate to the ATO why you're deducting the interest. So I think in these situations, the best thing to do is set it up correctly and make sure the loan purpose is correct, which I'm not saying every single time we would do this. Sometimes we can get a home loan style product and use it for investment purposes, but just be careful around it. And then he's asked about repayments. Because he's got a home loan, a non-tax deductible home loan, you definitely set up the investment loan on interest only so that you can put as much cash flow as possible into the home loan. Ultimately, you've seen, Dave's seen the compounding impact of not repaying home loans. Interest compounds both negatively and positively. So, there's compounding benefit of investing in shares or an asset, and those compounding returns is what really builds wealth. But compounding works negatively too. So, the less you repay off your home loan today, that you're going to have to pay interest on that next year and interest on that the year following and so on and so forth. So it's just as important. I don't want to be too focused on home loan because it's about building growth assets and leverage, and that they're the answers to building wealth. So it's not just about debt reduction, but there are compounding impacts. So you definitely split it as a separate loan. I would put it as an investment loan just to make sure the purpose was really clear and to not get yourself into a bit of a pickle in terms of having to mislead the bank about what the purpose is. And I would set it up as interest only and just keep your home loan on P&I. Put all your cash flow, as much as cash flow as possible, into the home loan, and obviously just pay the negative cash flow between, the investment interest only and whatever dividends you get. I should say this is the only observation that I've got here with Dave's assumptions. For the share portfolio, the assumed return was 6% growth and 2% for dividends. So 8% total return. That's not unrealistic, but I would probably, because of volatility and distribution of return, sequencing of returns, I would go something lower. We use 7%. And we typically go 3.5% income, 3.5% growth. Now, when I looked at our portfolios recently, just over the last 3 or 4 years, I think the returns were something like 13% total return and only 1% growth. So we will structure things in a way that aims to minimize income and maximize compounding capital growth. That's not going to happen in every single period of time because we'll get periods where we've got negative growth, for example. So we will do our best to minimize income. But I think from a modeling perspective, sometimes, with some hedged ETFs, sometimes they pay out a lot of income just because of the way the hedging works. Or, you might have a period of time where, because the capital growth is low, most of your return is income. So I would just say that's probably a little high. And I would probably put a little bit more income there just to say, well, we might have a slightly greater tax drag. Again, just to be conservative, although I would try and structure the portfolio so there's very little income. But I think great case study here, Dave, to sort of help people understand that the default, the commentary that I tend to make in this podcast is all about compounding capital growth, long-term returns, maximizing returns over the long run. And those things are all true, but it's equally true, in situations that might be similar to Dave's position. We might not buy an investment property. It might be too much gearing and it might retard our ability to repay the home loan or contribute to super or do other things or reduce our flexibility, because obviously more gearing reduces your flexibility. And there could be other reasons why we, choose a different strategy like borrowing to invest in the share market. Okay, next question is from Peter. Peter says, I'm 59 years of age, retired and turned 60 in May, and I'll be able to access my wrap super account, which I'll convert to pension phase, has about $2 million in it. Super's invested 75% growth, 25% defensive. We currently own our home in Gippsland, which is worth $1.5 million. My wife is still working part-time and tends to do so over the next couple of years, earning about $30,000. We get about $25,000 from an Airbnb. Wife's super is $400,000. Have no debt. 2 investment properties, a 4-bedroom home in Inverloch and a 2-bedroom in Richmond. Sons live in Richmond because they're going to uni for the next 3 years. Question, is it realistic for my wife and I to be living off $120,000 in terms of living expenses and still retain the 2.4 million in super to eventually pass to our sons when we die. We're mindful of not compromising our lifestyle too much, but the value of intergenerational wealth, but we value intergenerational wealth. I often listen to your podcast and aware of the different options that are available to us in terms of helping our kids in the future. I look forward to your response. So, Peter, I don't know. It depends on what the properties are worth. That's the kind of missing element here. Let's say Richmond, two-bedroom house. Let's say that's going to be worth somewhere between probably 1 and 1.5 or 1 to 2, somewhere in that range. Let's go 1.5. House in Inverloch, I have no idea how much a house in Inverloch. Let's go 1 million. Let's say the investment properties are worth, say, 2.5 million, just conservatively. And then you've got 2.4 inside super, and you've got the family home of 1.5. Will you be able to leave about $2 million to your kids if you're spending $120,000 a year? Yeah, my gut feeling is, yeah, that'd be right. But which assets will you leave? Well, who knows? We'll leave the family home because that's going to be tax-free, because you get the main residence exemption, of course. The super could be taxed up to 17%. That's not too bad, That's probably really tax effective. So if you want to maximize the amount of wealth, it's probably sell the investment properties at some point, live off super for a while. Before you're 75, sell the investment properties, maybe a few years before 75, because that's when, you limit your ability to be able to contribute to super. So maybe because your wife's super is 400, what you might do is sell one of the investment properties in, I don't know, maybe 10 years. 8 to 10 years, and that'll give your wife maybe 5 to 6, 7 years to get the money into super, which means that you could do one concessional contribution in one financial year and then carried forward 3 in the following. So you'd have to really work it out. Maybe you're going to need maybe 8 years to do that before 75. So what is that? Just thinking out loud, we're talking about 67. So actually maybe you need to sell the investment property in sort of 7 years or so, which isn't probably a bad outcome because you should probably get a bit of growth over that period of time. So it's really get the investment properties equity into your wife's super to bring her up to the transfer balance cap. And then you've got the other investment properties. So, you probably, tax effectively spend that first, but see how you go. And you're probably going to end up leaving quite a large sum of super and your family home to your kids. And, that's going to be pretty tax effective in terms of them receiving those monies. So I think you've got plenty of assets to play around with. It's really now sequencing how you're holding those assets, what the future returns look like, because that's the other thing too. I've made those comments in isolation without having consideration to, how your super's invested, the quality of the assets that we were talking about. A house, 2-bedroom home in Richmond could be on Richmond Hill, a nice quiet street, perfect house, or it could be, adjoining a commercial property and not ideal on a busy main road. So, I don't know the assets, and, that's a really important part as well, is forming a view around future returns. But it sounds like you're on the right track. You probably just need to think about kind of sequencing and tax impact. I guess the other comment I would make too is, at the start of the month, I recorded the episode underspending in retirement, but also underspending in terms of not giving away your wealth. So that's the other observation I would make is that, maybe you're better off, if you, what I talked about in that podcast, if you recall, is quarantining the amount of wealth that you need to, fund your $120,000 a year, then quarantining a buffer in case, things change, and then working out, okay, do I then have surplus wealth? And then if I've got surplus wealth, then maybe I should be passing that on to my kids sooner rather than waiting till I die. So that's the other thing you can think about, Peter. If your wife and you are really focused on intergenerational wealth, then your sons probably, they're at uni now, but they probably can make use of those funds, when they're younger rather than when you pass away, assuming, your life expectancy is long. I hope it is. So maybe that's another thing to think about. Of course, the other element to that is asset protection. So, making sure that if they get into relationships, they've got a financial agreement in place that sort of quarantines that assistance you've given to them as separate to the, asset pool. But, that's a sort of family court relationship matter. But that would be the other thing to really think about. So anyway, thanks for your question, Peter. It's an interesting one. Good luck with it all. And thanks to everyone that writes in. Of course, questions@investopoly.com.au is the email address. If you've got any questions, please send them across. Tomorrow, I'm going to talk about how to deal with portfolio concentration risk. So quite often we come across, clients that have particularly inherited direct shares. So they might have a lot invested in CSL, BHP, CBA. They're the typical Telstra. They're the typical ones that we come across. Often, maybe their parents have bought it at IPO, so they're sitting on a large capital gain. But it might not be shares, it might be a property asset. But how do you deal with concentration risk in a portfolio? So that's what I'm going to talk about tomorrow. And until then, bye for now. And before you go, if you enjoyed this episode, please share it with someone that you think will get value from it. And if you have a moment, leave a rating or review on Apple Podcasts or Spotify, as it really helps more people find the show. If you have a question you'd like me to answer in the next Q&A episode, email it to questions@investopoly.com.au. And if you'd like to learn about my new book, Wealth by Design, which is out in a few months' time, head over to investopoly.com.au/book. The link is also in the show notes. And you can also register for the pre-order offer, which is an AI tool that you can use to get more personalized value out of this podcast. Thanks for listening.